If you're in the market for a mortgage, be prepared for a whole new vernacular. I've put together the ultimate guide for approximately 30 terms you most likely will come across. It's a lot, so I'm going to split it up in a few different videos alphabetically. Enjoy. Amortization. This is a fancy word for paying down your mortgage's principal balance over time. By paying a little each month of the amount you've borrowed will pay off, or in other words, fully amortize the mortgage. And that's usually over a term of 15 or 30 years. Annual percentage rate. The APR is a way to calculate a mortgage's true costs, like interest, mortgage insurance, and points. More on that later. Cash out refinance. This is where you take out equity from your home and use that cash for things like home renovations or repairs. Consolidate high interest debt. Use it to pay tuition or any other cost. Closing cost. On the day of closing, when you're going to finalize your loan and get the keys for your home, you'll pay the fees needed to settle the transaction. These are things like your lender-related fees or closing attorney fees, escrow account deposits, and a few others. The closing disclosure will give you an itemized list of the fees needed to settle your transaction. Conventional loan. A conventional loan is a mortgage program that is not insured or guaranteed by the U.S. government. More details on this loan program in a separate video. Cosigner. A cosigner is someone that's there to help a primary borrower get approved when that primary borrower's creditworthiness and income is not sufficient to qualify on their own. That said, the cosigner's creditworthiness and income is also taken into consideration to determine the final loan terms, and they're equally responsible for the mortgage payments. Credit score. A credit score is a three-digit number that generally ranges from 300 to 850. It indicates the likelihood of you repaying your bills. It's calculated based upon your credit report's payment histories, the amount of debt you have, and the length of time that you've had debt. The higher your credit score, the more favorable terms your mortgage will receive. Debt to income ratio. Your DTI is how much you earn each month that's used to pay your debt. To calculate it, lenders divide your gross monthly income by your total monthly debt payments. Down payment. This is the amount of money that you put towards the purchase price of the home. The larger the down payment, the smaller the mortgage. The smaller the mortgage, the smaller the payment. FHA loan. This is a mortgage program that's insured by the Federal Housing Administration. More details on this program in another video. I hope you've enjoyed this segment of Wes's Wisdom.